have almost better than 40 people online right now, but we also record the sessions for future watching. So make sure that you keep it clean. It's always a challenge for me. And let's see, Sam and Brad, if you want, you can turn your cameras off too. So let me just, we are in our commercial property investment management module again, where the primary project goal that the students have is to construct an investment proposal to a high net worth individual who has been guided to add an alternative to his portfolio in the form of commercial property. But before we can snake all the way down and understand why an alternative is necessary, we want to go back and take a more holistic view of portfolio analysis and how you guide investors towards appropriate decisions in the broader context of the equities, in the bonds, in the mutual funds, in the options or futures or wherever the complexity of your investor is. So we had an interview on Wednesday of this week with a high net worth individual who was kind enough to share with us that his average annual IRS tax filing declared income is about $1.7 million a year, and he's been generating income in that range for about the last decade or so. So it's a person who has some means and some ability. So what we would like to do with you is first just get to know you a little bit better and your perspectives on what's going on in the market. And then I'm going to ask you some specific questions about how you would deal with an individual like this, were he a prospective new investor that you are considering taking on, so that we can help the students understand the language that's appropriate to be used when you're trying to guide someone trustingly towards making an investment under your purview. So let me go ahead and do this for the Dutch 2. I'm going to open up my chat box. So I'm going to set the agenda for us first. So the first thing we're doing is I'm introducing the session. And part of this is I want to make sure that the Dutch understand the tech rules. Again, I'm asking them to be on mute for the time being. I'm asking them to turn their cameras off for the time being. If they would like to ask you a question along the way, I'm encouraging them to chat into the chat box, and then I can relay the question to you. Then I'd like to have you just give an introduction to yourself and what you're doing, what you're thinking, so that we can get to know you a little bit better. Then I'm going to guide you through some interview questions that are related to your thoughts and opinions. Then we'll let the students ask questions directly if they would like, using their microphones if we have time, or if they don't feel comfortable doing that, they can chat so we can incorporate. And we'll close this thing up probably by 8:45 our time, 9 o'clock our time at the latest. Is that okay with you, Tim?
That sounds fine.
All right, so let me introduce our speaker. This is always a pleasure for me. So Tim Rose and I met, I think, when were you on the North Park board?
Oh boy, was that back in the 90s or was it the early
2000s?
Yeah.
So Tim came to my class and I asked him to give a guest presentation that was largely about how do young people find success early in their career. And to this day, I remember one of the students asking you a question to the effect of, how do you most successfully interview? And your first answer was, the first thing you have to do is smile. And to this day, I remember the men and women alone just melting in your hands right there. And so I knew at that time that you were a man of substance when it came to your personality. What I've grown to know over time is you're also a very savvy and successful professional investment advisor. And so I've invited you today to try to help them understand your perspectives. So why don't we start off with a question like this? What's going on in the markets today?
Oh, this is a very interesting time, as I think everybody knows. In the States, in the United States, of course, we have a change of leadership coming in January. And of course, we're recovering somewhat from a pandemic and an unprecedented black swan event of actually closing down capitalism in our country for a period of time. and all that entails, the intended consequences and the unintended consequences of that. And jobs report just came out a few minutes ago, about a half hour ago, and a little weaker than we thought, but we have to start addressing, or the Congress does at least, what kind of stimulus we're going to give the population after having their incomes taken away in one respect or another, either losing their businesses or losing their jobs. So it's a very interesting time, and people always say that, or they think, a lot of people do, that the stock market reflects the economy. Well, not necessarily so. The stock market acts as more of a barometer or front runner, leading indicator of what we think. We look forward, us investors, what we think the economy is going to do in the future. So these are some of the hurdles I get over. I've been very fortunate this year with our funds to have worked it out well and gotten good returns for our clients, but it's been a dicey period.
Mm-hmm. What was the expectation from the report today, and how much did we miss by?
Well, the expectation was maybe 300, in the 300,000 range, and we got 245. Unemployment's down to 6.5% or something in that range, which really doesn't mean a whole lot unless you dissect it. But so the V-shaped recovery is slowing down a little bit.
Mm-hmm.
And you have to address how we stimulate it going forward, since we still have a few more months at least of this getting the vaccine out. Hopefully people will tolerate it well. Hopefully people will take it, and getting things back on track.
Now, perhaps you can describe to them, when you say something like V-shaped curve, what are you talking about?
Well, of course, in March, if you look at a diagram of the S&P 500, when they shut the market down, the S&P 500 went down over 35%, and the markets were closed for a period of time. Not the markets, but the economy, and then it bottomed, as it always does, and then with anticipation of opening and stimulus, and people looked around to see what businesses were working and which businesses weren't working. Of course, there were losers and winners. The digitalization of our economy, good smart entrepreneurs like that ran certain companies that worked from home. You see me in my home right now. We decided those companies were going to work. So those of us that invested in those companies, of course, came right out, and the market valued those companies higher. And companies such as cruise lines, airlines, real estate companies, things of that nature, of course, didn't do so well. Mm-hmm. So what are the ramifications of that going forward? Well, a lot of us have decided that we can work just as well from home or some remote location, and maybe we won't need to go back to our office. I haven't been in my offices since January, actually. And so things seem to work out just fine with using services like we're using right now.
Yeah. Tangentially, this will stimulate our conversation for later this week. So you have a commercial office space somewhere that you rent or lease out and you see clients in periodically?
Yes, downtown Minneapolis, and probably won't be renewing that lease. I have a partner in business that has a nice home office too, and things can work quite efficiently like they are.
Yeah, so we're interviewing a commercial property manager next week who similarly has said, with the exception of his mental health professional offices, most of his buildings have been vacant for years, but he's convinced that people are going to renew. And I keep telling him, you should call Tim Rose. He's not going to renew his lease. But tell us, let's pivot a little bit into your career first. So remind us, you started as a finance quant jock out of undergrad, didn't you? You were a banking guy.
Yeah, well, even before that, Al, I started out at a company named IDS American Express. They call it Ameriprise now. And that was just a low-level financial planner position, basically essentially selling annuities, mutual funds, life insurance, things of that sort. And then I was very fortunate to get into investment banking, where I would establish capital for municipalities and public corporations and private corporations, either in the bond market or the stock market. And so I enjoyed that position and ran the Midwest. So I had an office in Minneapolis, one in Chicago, and one out in Denver, and had people in those. And we raised capital in capital markets. And then, of course, we had a trading desk in New York, and that was a lot of fun.
Mm-hmm. And what's the biggest piece of lucite you were able to put on your desk during that period? Do you remember?
Well, in terms of, I did a $600 million O'Hare Airport deal.
Bonds.
Bonds.
Yeah.
The municipal bonds. So that was my biggest deal, but I did a lot of other deals. I did over $6 billion or so in various financings during that time, and had a lot of fun. It was a good run. If anybody wants an adrenaline rush, become an investment banker on Wall Street or someplace, and you'll have a lot of fun and meet a lot of interesting people.
But eventually your career took you into a different direction. At what point did you circle back and say, I want to reincorporate investment advisory?
Well, I always kept T. Rose and Associates Incorporated as a little side business, because I had some clients that wanted to stay with me, and I always knew I might come back someday. I was with a firm named United Daniels Securities, a Wall Street firm, private Wall Street firm, and Willie Daniels, my boss, decided for some reason at some point to put me in charge of their asset management branch. So I learned to manage money on an institutional level at that place, at that branch. And so when I decided to retire from United Daniels in, gosh, what was it, 96, I had a whole new perspective and understanding and list of contacts for the institutional world. And I had more money in my pocket too, personally. And I decided to come back to T. Rose and build it into something that I thought I wanted to run. So today, I'm somewhat of a multi-strategy hedge fund. I still have my original first client. Of course, she's not involved in anything risky. She's very conservative. She's 80 some odd years old. Her husband has passed away now. But some of the other clients that have come on are more involved in hedging and stock options and things of that sort. So that's where I am today.
And was it, remind me, early 90s or so when you started doing T. Rose and Associates full time?
Well, that was incorporated in 1991.
Got it.
And when I left United Daniels in 96, that was when I was able to fully focus on T. Rose. I actually started T. Rose, and it wasn't profitable. I wasn't making enough money to do anything. I really didn't know a whole lot about money management at that point, but I had a dream. And then after spending time on Wall Street and so on, I figured out what I needed to do and who I needed to do it with.
Well, now as an expert, your website prominently displays that you are a quote unquote fee-only fiduciary. What does that mean, and why have you chosen that as your business model?
Well, as a fiduciary, as a true fiduciary, and there's a lot of different people calling themselves fiduciaries today, my model is fully transparent. So you know exactly how much I'm charging. It's based on actual management, on assets under management. And I like to say that in that aspect, I'm a partner with my clients. So as they make more money, I make more money, and of course, vice versa, versus transactions, buying and selling of products and assets and things of that nature. So if my clients open their if they open their account on their mobile phone app, they can see exactly what's happening, every fee, every transaction that's taking place. And as a state, from a state regulatory standpoint and from the SEC standpoint, a federal basis, before I charge my quarterly fees, they have to get an invoice, which delineates every aspect of the calculation, what that fee, what that percentage is being charged on. And of course, there's a contractual agreement. So if they say, Tim, we want a hair on fire growth and risk and the volatility and some of the other things that go with it, perhaps they're going to pay a higher fee. And they don't want that sort of thing. And they just want Home Depot and a computer in their portfolio. Of course, that's not a labor involved portfolio, and they won't have to charge as much of a fee.
Yes, so we're starting to get some questions that are along those lines. But before I get there, help us size up what you're doing in terms of, let's start with approximately how much assets under management are you working with these days?
Currently in the strategies that I just laid out, about under 100 million. And I'm in the process of starting another fund, and that will probably be about in the same area, I would guess. That's more of a pure hedge fund. It would be a registered investment advisory firm, but it would be formed as an LLC, which instead of clients having separate accounts at a TD Ameritrade or something like that, it would all be custodianed with a TD Ameritrade or some third-party custodian, but it would be shares in this LLC. They would be shareholders and have their money pooled with other like investors, accredited investors, multimillionaire investors.
So with $100 million under assets now and the prospect of doubling that in the future, do you spend sleepless nights worrying about your clients' money?
Well, you know, Al, I don't really worry about the money. I've been doing this for long enough. We have a strategy that so far has worked, you know. I think more about, am I positioned right? If you look at my portfolios, there's multi-strategies going on. If you look at what I'm hedging or what I'm long or what I have puts on, and so on. So there's a number of things going on at any one particular point. And when you play out the game theory involved, for instance, buying puts on Zoom, and of course that's a bet that of course at some point these vaccines will work, people will get back to work, and a valuation of 300 times sales may not be as appropriate as right now. So it was a great ride, and I have to admit I rode that for a bit. It was in the portfolio. It's no longer in the portfolio, and now we're taking a bet that perhaps in June or there somewhere thereabouts it may reverse. So you have a number of things going on, and I wake up sometimes thinking about, did I play this game theory out properly or not? And what happens in July 5th with the Georgia vote, if the new administration coming in has carte blanche on their policies, and how that's going to change, how's that going to affect the economy going forward with that whole new approach, versus if we have gridlock in our United States Congress and the new administration doesn't have a free hand and they have to negotiate. These things I think about.
So Stan had asked the question, how did the coronavirus affect your choices on investments? So I think you just addressed that. You found some skyrockets, grabbed some short-term positions and held on to them, and then exited prior to a perception of a decline.
Yes, you know, I have my screen up right now. So when that happened, I sold out of a number of positions, and I established positions in companies like DraftKings, which is I established Facebook. I bought more of that. Lululemon, which, you know, I don't know about you, but you may be wearing some Lululemon tights right now. I don't know.
My daughter is. She's on her way to work out.
Yeah. And NVIDIA.
Yeah.
People are gaming and online. Shopify, which is a company which facilitates online commercial companies. Tesla, of course, which had its value, was on my radar for many, many years, but I couldn't get comfortable with the valuation. But its valuation was cut in half. So right now I'm up over 400 some odd percent in that position. I have since taken off all my capital and I'm playing with the house's money. So things like that, the digitalization of our economy. And Al mentioned that, yes, some of that short term as far as the enthusiasm behind it.
Mm-hmm.
But if you take off your risk going forward, DocuSign, I'm going to be using that service in the future. Now, do I want to pay that high multiple for it? No. And that's why you reduce that position or you buy some puts on it. So when it gets a more reasonable valuation, you can profit on that as well.
Yeah. So I've got a couple other questions here, and I know you love one of them, which is you talk about your strategy. So let's first talk about technical versus fundamentals, and then you can tell us about being a contrarian. So when it comes to your strategy, what are you looking for primarily? Are you a fundamental guy looking for financials? Are you more of a technical trader, or what's your take?
That's very interesting. The reason most mutual funds don't beat their index, whether it be the S&P 500 or the Russell or whatever their index may be, is because they're closet indexers. If they work for a big company, they've got to get their bonus, they've got to beat by X percent, and if they don't beat, they get fired or something like that. Since the market, and when I say the market, institutional investors, retail investors, they have different criteria which they look at. 200-day exponential moving average, the 50-day average for chartists. They look at market sentiment. They look at relative strength index, things such as that. That's technical analysis, and that matters to large institutions. Those are market moving fundamentals, or technical analysis, I should say, that matter to some people. Then you have the guys that say, okay, I'm a top-down guy. So I look at the sectors in the S&P 500 and try to determine which one's going to go up, which one's going to grow in the future, and which one may decline in the future. Then you have the bottom-up guys, the guys that look at each company individually and look at those financials, look at their moat, look at their management, their product, their service, and try to see who's strong and who's going to have something strong going forward. Well, I look at all of those things, quite frankly. I know the market's very emotional. Is the market efficient? Yes, it is over a long period of time. Right. But as I know, on a day-to-day basis and sometimes hour-to-hour basis, you can see some companies that may gyrate 5-10% in one day, sometimes based on rumor, sometimes based on the sympathy of another company in their sector that has no basis on them. For instance, if Home Depot, there's a rumor that their CEO has run off with their lover, leaving the company behind and doing he claims he's running off for personal reasons. Maybe Lowe's is going to go down to 5% just based on that rumor. Yeah. Maybe Lowe's has nothing fundamentally going on with them to make their stock go down 5%. Perhaps that was on my buy list and I need to take a look at it because now it's selling at a discount. Did that answer that question?
Well, you didn't tell us about your favorite part, though, which is being a contrarian.
Well, right now, let's look at it from a large market perspective. The market's very bullish right now. We're at record highs in most of the indexes. Everybody's leaning to one way. I like to go the other way. I'm hedging. I'm looking at ways to make money when the market eventually has a correction, which it will. It's just a matter of time. If you look at the market over time, Al, if you even just every year we see corrections, 5-10% is a correction, right? And those are great opportunities. Those are the times when I make my alpha.
Mm-hmm. Mm-hmm. Tell us about, are you tracking the VIX? Is that something that you pay close attention to as well?
VIX is an indicator. That's one of my indicators that I look at. I look at about 6 or 7 different indicators at any one point in time, and right now we have it trending down there. There it is, a 20, and it could get, I don't know where it's going to go. It's very volatile, and I actually use it as a hedging instrument as well.
Mm-hmm.
Because it's you'll see it trend down and trend down. Who knows if it gets under 19? Usually, in fact, I have a chart of it over here that I watch, and once it gets down around 14 or so, or 12, perhaps that's a time when I need to start thinking that there's going to be an inevitable correction.
Mm-hmm.
People get too comfortable. People traditionally do the wrong thing at the right time, the wrong time. There's a herd mentality, and you
Yeah.
really have to go against the herd. When people start getting comfortable, that's when I get uncomfortable.
Mm-hmm. Maybe you can, in a sentence or two, describe for them what the VIX represents to you.
Well, you have puts and options, that people are trading all the time. And when it starts going down, I think the best way to put it, and it's an inverse correlation. So when it starts getting down to, I'm looking at a 1-year chart right now. Prior to COVID, it was running around 12.9 or so on average, and it would gyrate. So that means markets are calm. People aren't betting a lot that there's going to be volatility in the future.
Mm-hmm. Mm-hmm.
Options. And when it gets 12, people are pretty comfortable on what's going to happen. When it spikes up to a 85, and that's where it was, and they chop things down, that
Yeah.
means people are running to buy puts. They're running to cover,
Yeah.
and the price of puts shoots up. And of course,
Yeah.
that's a good time to go the other way.
Yeah. Although the context is the orange juice futures markets, I always think of the movie Trading Places when I
Oh yeah,
start thinking about the VIX jumping to 85.
yeah, great movie, great movie.
I got a couple other questions here then. I'll ask this one and then we'll circle back to another topic. So, Nick is asking, at present, are you a bull or a bear?
Over which period of time?
How about through Q1?
Q1, I would be bearish.
You're bearish through
I'm
Q1.
still net long, but as the market creeps up, I buy more and more puts. With the valuations and the market where it is, all the analysts, and typically analysts are wrong, incidentally. There's not too many analysts, buy side or sell side, that are actually any good at what they do. But right now, the indicators for next year are that companies are going to beat, what they did this year in terms of profits and so on.
Mm.
But with the market going straight up, not straight up, it goes in a jagged line like it always does. It's about time for a correction. Am I going to call when it's going to be? No, I don't know when it's going to be. Nobody knows when it's going to be.
Yeah.
But we have a new administration coming in. A lot of people are happy about that. Some people are not happy. The markets have gone up in anticipation of a new administration, in anticipation of gridlock, which is good for the markets typically, in anticipation of a vaccine. We don't know. We've heard of the efficacy of that vaccine, but we don't know how much immunity it's going to bring. And we don't know how the public will tolerate it or not tolerate it. We don't know how many people are going to take it. A lot of unknowns. And typically, when an anticipated event comes about to actually occurring, markets tend to sell off.
Mm-hmm.
And
Mm-hmm.
New administration coming in, we're possibly 2, 3, 4 months into people being vaccinated. Maybe we get some horror stories out of the UK because they're getting it before we do. Who knows?
Mm-hmm.
So there's a lot of unknowns, and the market's at a high. The probability at this point is that we're going to have a correction. But going into all of 2000, I will be a bull. However, I can make money if the market's going up or going down.
Yeah. Yeah.
I'm up year to date 163% net of fees in my most aggressive portfolio. And it's when you figure out how some of these things work, you can make money in up downs. Up markets are down markets.
Yeah. So we've got a bunch of other great questions coming in that I'll try to get to all of them if I can, but I want to circle back in this last half hour and reconnect us to the idea of working with investors and dealing not only with the technical market side, but more the psychological side of doing investment management with human beings. So let's assume that I represent a new high net worth individual who is considering investing in your second fund that you're proposing, and it's our first meeting together. How are you going to get to know me? What types of questions are critical for you to ask and understand in initial meetings with prospective clients?
Well, prior to having that face-to-face meeting, Al, I would have already done my homework on who you are, where you've been, how you made your money, your success at this point, the 1.7, how you where you have that money, if it's in commercial real estate, if it's in, if it's long-term capital gains, short-term, if it's passive income, how are you getting that income? Who most likely if you're a person of that status, there's somebody else who has done business with you, and getting all that information will determine if I want to do business with you or not. And there's a lot of people that have a lot of money that people like me should not do business with. Maybe they want to sue you at the first moment something doesn't go their way. So those are some of the things I would establish prior to the sit-down meeting. In my business, if you're sitting down with me, you've already figured out who I was. You have a good idea of what my track record is. I just had a young lady of 83 years old call me the other day, and she said, Tim, I want to work with you because so-and-so said that, you're making money for them and blah, 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 blah. So people that come to me I have a reputation, hopefully good enough. Al's still talking to me. And they know pretty much what I do and how I treat people and so on. So Al, with his $1.7 million income, knows who Tim Rose is. He's heard about me. So that first meeting is establishing a relationship. We'll talk about who we know in common. We'll talk about your interests, Al, if you're a squash player. We'll talk about your family, if you're on your fourth wife or your fifth wife, and what you think of her. And we'll talk about all those things. And we'll see if we like each other. Because in my business, if you like each other and you trust each other, if you trust this person that you think you may invest some money with, we've already established that the guy has a good track record, you'll most likely do business with him.
So let's pretend then my track record in terms of investing is my wife deals with all of the finances, but I have a bunch of commercial property investments right now, and that's all I know. What would you start trying to do to encourage me to think about diversifying my portfolio?
Well, first I'd insist, if that's the case, that the next meeting we have your wife present. And in the U.S., women make a good portion, even though, a lot of guys think they're macho men and all this sort of thing, their wives still determine, who they do business with. is in terms of household investments. And you don't have the true decision maker on board, you may not do business with that individual. Sometimes you do have a man that runs the whole show, but if you don't have a relationship with that wife as well, and have a good relationship with that team, you don't have a good relationship with that household. So I would say, Al, bring your significant other along with you, because Al may say, yeah, I want to have 165% return. And his wife may say, Tim Rose, that's great, but I'm not interested in that. I want more of a blue chip return, more of a 20% return, and the risk and volatility that goes with it.
So when you're having those conversations, and I was to ask you something like, hey, Tim, all I want you to do is be modestly aggressive, but make me 20% returns every year. What are you going to tell me?
We have to quantify that. What does modestly risky mean to you, Al? Because if a guy has $1 million, for instance, and he says, well, yeah, I want to beat the markets.
Yeah.
And then you say, well, Al, what kind of risk tolerance do you have? Well, let's quantify that risk tolerance. If that $1 million goes down to 900,000 in the next 12 months,
yeah,
what's going to happen? Now, it may not change your lifestyle, but $100,000, you may think you can have that kind of volatility and still sleep at night, but possibly you cannot. Not everybody can do that.
Do you use any type of specific risk tolerance questionnaires, or is it just through your own personal interviewing that you kind of assess someone?
Starting out, Al, I would use this very elaborate planning tools and graphs and charts and various things. But I've learned over the years that, back to that example of $1 million, if you ask somebody if they can lose 10%, they may say yes. If you ask somebody if they can lose 100,000, that means a whole different thing.
Sure. Yeah, I don't mind losing 10% of the $10 I invest. Oh, no. All right, you told me I lost $100,000.
Al, you there?
Do you mind if I ask you a question, since Al isn't here anymore?
Oh, not at all.
So we have to in 2 weeks you have to make this pitch. What are some key elements that need to be in a pitch that should be talked about or should be addressed?
Who are you pitching?
It's a teacher of ours.
Okay.
It's a teacher of ours.
A hypothetical client. Hi,
Yeah.
Al.
You told me I lost $100,000. I think I passed out for a minute. But go ahead. I'll let Dick lead the conversation for the time being. I certainly don't mind. What were you guys talking about?
No,
Yeah.
yeah, you were taking a few minutes, so I was just asking. So, what is the hypothetical? Is that he has about 7 million in Bitcoin money, and he wants to allocate that to yeah, to other investments, to real estate, for example. So, what are some topics that need to be addressed in such a pitch, or what do you suggest we talk about?
Okay, so I kind of assume if he has 7 million in Bitcoin, he's probably a younger millennial type guy that was smart enough to get some Bitcoin in his portfolio, make a lot of money with it. So let's just assume it's a woman who's 32 years old, single, savvy, highly educated. But of course, you don't want 100% of your assets in Bitcoin. She's had a good run. Bitcoin has no intrinsic value, and I have Bitcoin. I don't any longer, but I've done well with Bitcoin. But you know, I couldn't, and I bought it to try to figure it out. But at this point, does Bitcoin make a good alternative investment? Yes.
Yeah.
Should it be
Should it
the
be the
primary?
primary?
Oh no.
Oh, no.
So
So
I would suggest to that woman. I'm echoing for some reason.
for some reason.
I would suggest to that young lady that she diversify. Perhaps, you know, at this point, commercial real estate, it would need to be geographically diversified, the real estate portfolio. And I won't get into all those details, but she should have allocations in some municipal bonds, allocations in global equities, allocations in some real estate, of course. She should have a cash position, possibly in some sort of in euros as well as dollars. And just get a nice, you only have to get rich once. And if she got rich in Bitcoin over the past short period of time, take that money, pay the taxes, and diversify.
Okay, excellent answer. So, thank you very much.
You're welcome.
Let's see. Dane, you have your hand up.
Yeah, that's my last name.
Yeah,
Oh,
you don't have your first
oh.
name on there. Okay, go ahead.
Yeah, no problem. Well, you just gave some great advice, I think. But if I were this woman, I might be thinking that there's no reason to diversify right now because my profits have been huge. And right now, I don't understand yet why I have to diversify. Could you explain why that should be handy for a girl in this situation?
Absolutely, Sam. You know, yes, your profits have been astounding. But as I said before, you only have to get rich once. Now you have to stay rich. And if you look at a graph of Bitcoin, and you can assume, you know, anything you want about Bitcoin, maybe it continues going up at the pace it has. Most things do not. Of course, Bitcoin's a whole new asset class, and most people don't understand it. But let's say you take 1 million and you leave it in Bitcoin, and it continues to go on and appreciate at the rate it has. Great. You'll continue to make a whole lot of money. But then you have, you know, $6 million in municipal bonds, in commercial real estate, in other asset classes, which will make your position more stable going forward and reduce the risk of total loss. One will go up as the other goes down. And you'll still have that exposure to that fantastic opportunity in Bitcoin if it continues to be a great opportunity. And if I showed her the graph of what has happened in the past when it's collapsed, perhaps she'll be more convinced. Perhaps she won't be.
Okay, thank you.
You're welcome.
Excellent. Anybody else want to go ahead and chime in and ask Tim a quick question verbally? You're certainly encouraged to do so. Go ahead, Stan.
As a starter on the stock market, would you suggest to start up with some small single stocks, or you buy some other stocks, or would you suggest start investing your money in ETFs, TACers, funds?
For yourself personally, Stan?
Yeah, it's not for me personally, but I got my own stocks. But what would you rather suggest to the young people who try to start at the stock market?
I would suggest to have a base of just an index fund, a global index fund, an S&P 500 type fund, something like that. But then I strongly encourage people to figure out what they're interested in, figure out something they can take a look at and learn about, and buy an individual stock or two. And if they feel comfortable with it, and if they're disciplined, in other words, not being emotionally involved with the stock, go ahead and invest in that stock and put a portfolio together.
Okay, thank you.
Absolutely.
One thing I always suggest, Tim, too, is for the fun of it, go ahead, build yourself an Excel spreadsheet, do a little data feed, and do some hypothetical trading, and ask yourselves, how would I have done?
Yeah, absolutely.
Great. Isabel, please go ahead.
So you briefly touched upon risk financial factors, or just how you determine the risk associated with a property. Would you say that before determining the investment potential of a property, are those factors the same as the risk factors, or are there other financial factors that you look at? If that makes any sense.
Well, if I was going to look at a commercial property to evaluate it at this point, and let me add that, I was looking the other day at a chart I think it was a Wall Street Journal, that showed commercial real estate. Of course, it fell off a cliff and then it started to recover, and now it's going back down. So as a contrarian, as Al called me, and that's what I am to a large extent, markets always overcorrect one way or the other, on the upside and the downside, right? So they overcorrect. Everybody thinks it's never going to recover. They think the world's going to hell. Everything's going in the toilet. So so I would look, number one, at that valuation on that property and what its historical valuation is. And under the worst case scenario going forward, what kind of income can I derive from that property if things are still terrible a year from now, 2 years from now, 5 years from now? And I would finance it. You look at the loan to value, you look at the debt coverage, you look at at the occupancy, all those different things, and you do your pro forma based on that criteria. And I might have 3 different scenarios that might play out going forward, but I wouldn't plan on the most optimistic. I would plan on the most pessimistic, paying that mortgage under that most pessimistic scenario. And that's how I would approach that. Did that answer your question?
I think so. I think I have a little bit more research to do on the terms you just named, but I'm sure I'll figure out exactly what you were talking about. Yeah, okay. But thank you.
You're welcome.
You did more than that for me, though, Tim. After this, we're going to take a break, and then I'm going to help them start to develop a valuation model for a property that's going to include LTV analysis, debt service coverage, 10-year cash flow projections, excellent, pro forma with a baked-in 8% preferred dividend. So you just teed that up perfectly. Thank you.
You're welcome.
Yeah. We've got about 8 minutes left if needed. Does anybody maybe want one more question? This is where it gets awkward. No one's going to ask a question when you tell them that we're under time constraints. I should just know better and just suggest that we do it this way then. So I'll finish with something personal here. My daughter popped her head in on her way to the gym, And she said, "Dad, what are you doing?" And I said, "Oh, I'm interviewing my mentor." And she goes, "Ooh, Daddy has a boyfriend." And what I'm gonna close with the Dutch is an understanding of, you and I have known each other for the better part of 10, 15 years, but it's really only within the last year that we've spent substantive time in conversation. And it was a result of me deciding to practice what I preach in terms of like when Sam asked to suggest to a young person for investing. When people ask me, what do you suggest for a young person when it comes to relationship development? I said, what you need to do is identify someone and ask them if they would be willing to serve as your mentor. I did that with you earlier this year, and it was like being an 8th grader asking a girl to a dance all over again. The sweaty palms and, the nervousness. But in hindsight, it was maybe one of the best risks I took this year, because what it's allowed us to do is to get to know each other, not only personally, but professionally, where you have provided tremendous value, not only to me, but have continued to contribute to my profession and what I do with my students, which is a legacy contribution that you're making that I want to recognize out loud. So thank you very kindly for what you've done. So Dutch, let's go ahead and turn our cameras on again. And let's see, we should figure out maybe, other alternative dances that we can do, or maybe there is, some type of virtual hug that we can give Tim. I'm not quite sure how that's going to work, but let's go ahead and, as we say our goodbye, let's keep it simple for now and say, ready, Tim? Thank you. 1, 2, 3, right. 1, 2, 3, left. 1, 2, 3. And there's the dancing Dutch for you, Mr. Rose. Thank you for your time this morning. I'll invite you to log off, and I'll keep the Dutch with me for just one more minute.
Good to see all of you. Thank you.
I'll talk to you soon, Tim. Thanks.
Bye now.
Bye.
Bye.
All right. Okay, so it's 8:55 in my time, and there are still 41 of you, so thank you for sticking that out. Tim's a very interesting guy, and I told you, handsome as it gets, Daddy has a boyfriend. So let's do this. Let's take a 35-minute break. So at what's 9:30 my time, which is what, 16:30 your time? Is that right? 16:30 your time. We're going to come back together. In the meantime, if you're not sure where it is, let me show you one more time. So if you go to our team, and within our team, if you go to that general area, if from the general area you go to the files, we're going to work to build this 9-page spreadsheet later in 30 minutes or so. I suggest you open it up and just start scrolling through and looking at what it contains. And what I am going to do with you then is I'm going to have a template with just the text in it for the most part, so I don't waste my time typing. And I am going to build out all the calculations for you, discuss the assumptions and how they drive the decision making. And I'm going to record myself doing that for about an hour. So it'll be mostly passive. I'll invite you to turn your cameras off and to just play around on the side and to ask questions if needed. But it's not necessarily like I'm going to wait for you to finish before I move on. But rather, after we're done with that first session, you'll have the weekend, and then next week I can come back and rebuild it for any of those that need more help. So I will see you all in about 30 minutes.
Thank you. Bye-bye.